You're listening to the Real Estate Entrepreneur Podcast with Terrence Murphy, where we cover sales, investing, and entrepreneurship with an emphasis on real estate. Each podcast, Terrence and his guests will bring you informative and inspiring information within the real estate industry.
Welcome to another episode of the Real Estate Entrepreneur with Terrence Murphy. We are here to talk about all things real estate entrepreneurship. So sales, investing, and entrepreneurship. So today, I start off with a simple quote, and it says, "You did not wake up today to be average." So if you guys are out there and you're listening, keep dreaming. I think we become adults and we forget what it means to dream. And I always tell people, just remember what you felt when you were a child, all those dreams you had and all the things you wanted to do and see and accomplish. Keep that same mentality and you will do really well in this life. But I want to welcome my guest, Mark Willis, to the show today. Mark is a certified financial planner, a 3-time #1 best-selling author, and the owner of Lake Growth Financial Services, a financial firm in Chicago, Illinois. As a co-host of the Not Your Average Financial podcast, he shares some of his strategies for investing in real estate, paying for college without going broke, and creating an income for your retirement you will not outlive. Mark works with people who want to grow their wealth in ways that are safe and predictable, to become their source of financing and create tax-free income in retirement. Welcome to the show today. Thanks for being here, bro.
Thanks, Terrence, for having me on. And I love the quote.
Yeah,
Never be average, guys. Never be average.
Never be average, man. So tell us a little bit about who you are, your background, what brought you into the real estate entrepreneurial space or finance space. And let's start there.
Sure. Well, I was thinking too about that quote. Our podcast is called Not Your Average Financial Podcast. And I guess you could say I'm not your average financial planner. I'm a certified financial planner, but I'm not exactly keen on the typical traditional model of financial strategies. And it comes out of my story. I graduated from Abilene Christian University, not far from where you're at there in West Texas. Actually, it's West Central Texas. And we graduated, my wife and I, with 3 private school degrees between us. And my graduation date just so happened to be 2008. Now, Terrence, was there anything going on in the real estate space in 2008?
I'm not sure there was, but yeah, crazy times.
Yeah. We moved to Chicago, which is a nice, very affordable, small town to live in. Joking, of course. And had no jobs and $120,000 of student loan debt and really no income to pay it off with and no plan. More importantly, we did not have a plan to pay it off. It just sort of we fell into our debts like so many Americans do. And for me, that was my wake-up call that something had to change because as it happened, I ended up marrying 2 women in college, my beautiful, amazing wife and this lady named Sally Mae. And Sally Mae was around like every month asking for cash. So that was sort of our introduction to this world called money. And alongside that, we were learning about the financial crisis like most Americans on the evening news. But it didn't really register with me until I started working with a CPA firm and learned a little bit about how stories were being played out. Real American lives were being crushed as a result of things that they had no control over. For example, I was listening to this CPA that I worked for make the call, right? Make that dreaded call to her 63-year-old clients saying, "Hey, Mr. Client, I'm sorry. I know you've been working for your entire life. I know I've been managing your money for 20 plus years. But I just lost you half of your life savings. You can't retire in 2 years like we thought you would." And to me, that was sort of a eye-opener that this whole house of cards we call a financial system could come crumbling down. And I didn't want I didn't want my own life, my career to be wrapped up in that sort of madness. So I almost got out of the business of finance altogether. And for reasons we can maybe get into, I stuck with it, obviously. Ended up getting my certified financial planner designation. My wife and I found an incredible alternative way to build real wealth and pay off our debt at the same time and become our own source of financing. And that's become our calling card. One of the things I specialize in as a financial planner, and the advisors and associates that work with us here, we work across the country, all over the country, to have one-on-one discussions with folks to figure out how they too can buy back their debt and build real wealth at the same time.
Love it. Love it. So what is real wealth to you, Mark? What does that mean? When you hear wealth, what does that mean to you?
Yeah, wealth is such a broad word, isn't it? Yeah. I think it's funny. We think about how money is really pointless paper, worthless stuff in a drawer or in a bank account on digits on a screen. But it's interesting, that money seems to really not be all that important, and yet it touches all the important things of one's life.
Mm-hmm.
Think about your charities you care about the most, your children, your legacy, your own health, your experiences that you're going to have in your life. All of those things are what comprise wealth, in my opinion. Money just seems to be a conduit to help get you to those things, those really important things. And I think, like Scripture tells us, it's the love of money that gets in the way, and it's the root of all evil. But it's because it stops us. It's almost like it's the first train stop on the real train to meaning and legacy and responsibility and joy. The real wealth is in your relationships, in your charity, in your giving, and in your legacy, and so forth. So that's real wealth, in my opinion. What about you, Terrence? I'm curious. What is real wealth to you?
Man, I got a long answer, but I just would say legacy, because I always say all money is a magnifying glass. It's just a magnifying glass of who you already are. So if you're a giver with no money, you'll be a giver with money. If you are someone who loves helping people with no money, when you get the resources, you're going to help more people. And if you are an asshole with no money, when you get money, you'll be a bigger. And we can finish the sentence. And so I always say, to me, wealth is about building a legacy. It's about breaking generational curses. It's about making an impact for the kingdom of God, because none of this is going with us anyway. And then it's about bringing other people along, because the biggest pivot I've made in the last couple of years is I don't want to motivate people anymore. I don't want to inspire people anymore. I want to motivate and inspire, but then there's extra steps. Then I want to give them access to the information, give them the tools, give them the roadmap, and then they can go replicate what I'm replicating or what I'm executing. So I'm not just talking to you about it. I'm not just showing you an Instagram reel. I'm saying, hey, here's the steps. Here's the information. Because the biggest thing I've learned when I really went on my financial literacy journey is that I didn't even know that information was out there. And I had I was 3-time academic all-conference. I had a degree from Texas A&M. I was a studious person in high school. My first couple, offers were academic offers. So long answer is giving people just putting the thought in their mind that is possible, that you can understand financial literacy on your own, to me is the biggest thing you can give people. It's like the blue pill and the red pill almost the Matrix.
It's true. And couldn't have said it better myself in so many ways there, Terrence. I think we're really aligned in a lot of ways on that. And, I think too often traditional financial planning has been about, hey, give me your money and let me sit on it for 40 years and charge you a fee for it. And then maybe I'll give a little bit of it back to you when it's time to retire. That's kind of the traditional model. It's literally called assets under management. Right? It's your assets under their management. And by the way, they'll charge you a nice hefty fee for that, 1.5%, whatever, which, right, that doesn't sound like a lot. But according to the Department of Labor, if you gave your money to an IRA or a brokerage account or 401k, and they just charge a nominal 1% fee, which is the average. It's actually below average, 1%. The average is closer to 1.7. But if it's just a 1% fee, according to the Department of Labor over 30 years, that's 28% of your nest egg eviscerated just to fees.
Wow.
That's a third of your life. That's like you sitting in that chair at your day job, your workaday job, or whatever you do for a living, working for your investment advisor. He's going to retire or she's going to retire before you can.
Wow.
Now, does that make sense? Who's taking the risk here? Is it his or her money, or is it your money? If we're willing to outsource our money mindset and our financial life to a guru or a financial expert, I'm sorry, but that's a dangerous way to live. It's not benign just to hand it off to somebody else and hope and pray, right? Hope and pray is not a strategy. So I'm with you all the way on that. I got to take control. And you're right, man. I can't motivate. But like a good Texas buddy of mine once said, Mark, you can bring a horse to water. You cannot make him drink, but you can salt the feed. So find ways to salt that feed.
That's good, bro. Wow. So what was that pivotal moment that you had when you said, you know what, the path that I'm on, which like you said is, college tuition, debt, and whatever, I'm just going to work a a W-2, set up my 401k, and just wait till I'm 68 years old, 65, 63, and retire. What was that pivotal moment that got your attention? Was it the '08 crisis?
Well, it was a mess of different events. Think of it almost like me hitting my head against the wall over and over again. That was sort of that pivotal moment, you might say, just finally waking up to the insanity of it all. Because here I am in my mid to late 20s at that moment, throwing my most invaluable dollars into a hole called my student loan debt. And I say those are my most valuable dollars because they are the dollars in your pocket when you're at your youngest. So whether you're 8 years old or 35 years old or 80 years old, the money in your pocket right now is more valuable than the dollars in your pocket 10 years from now. Why? Due to opportunity cost. And that was my, if you want to call it a light bulb or aha moment, I realized that every dollar I spend, I'm losing for the rest of my life, but I'm also losing anything that dollar might have done for me and my family for the rest of my life and their lives as well. And that was the big wake up call, if you will, Terrence. And so it was a moment when a mentor of mine from my alma mater, actually, he sat down in our little apartment in Chicago and he said, "Mark, I've got something important to talk to you about. I know you've been fighting through this student loan stuff. And sorry about that, by the way, since I'm a professor there." But then he said, "Mark, I've got something I want to tell you." And he described something called bank on yourself. And he described it to me and my mind shut off, my arms crossed, my eyebrows got kind of low. I kind of turned them off and I didn't believe anything he was saying. And then he said to me, "Mark, is it possible that Dave Ramsey could be wrong about something?" And he just let that question sit there for a minute. Maybe that was my aha moment too, Terrence, because it was sort of that realization, because the concept of bank on yourself sort of flies in the face of something that Dave Ramsey taught. And Mr. Ramsey's been pivotal for millions of Americans, myself included, got me started thinking about money, got me with envelopes in my wallet and started getting me out of debt, so to speak. But I realized that I was following a specific method called the Snowball method of paying off my debts. I was just throwing that money down a hole and I'd never see it grow for me ever again. But when I discovered a strategy called Bank on Yourself, that became for me a pivotal moment in my, not just my financial life, but my children and my children's children. It changed our family tree. So that's been one of the big aha moments for me. And, it was in the midst of the 2008 crisis, all that happened for sure.
Man, I got a lot I want to unpack because it's so important. Real estate entrepreneurs, a lot of them are on their second, third, fourth, fifth career by the time they find real estate. And they're coming into the industry with debt, just like out of college. And it's crazy. So I know this is God's going to use this episode for sure to impact a lot of people. Because as you were saying the words, I would literally write it down and you would say it. I literally wrote down snowball debt, then you said it. I wrote down opportunity cost, then you said it. Like you were literally saying it. I would write it, then you would say it. Almost like I was writing on the teleprompter. So when you think opportunity, I want to go back and unpack some of that, because for our real estate entrepreneurs who may be in debt, who may be following the Dave Ramsey, I call it the American dream: get a job, go to college, get a degree, go on all these interviews, work your 8 to 5, save your money. You hear save your money, which we know cash is trash at times. But what would you say if you were to give me the meaning of opportunity cost? Because I want to break that down. That's a really important topic for people to understand. Walk me through that, Mark.
Yeah. Well, I'm going to say a bold claim, and you tell me what you think as an answer to this question. The bold claim is you finance everything you buy. You finance everything you buy. Either you pay interest to another banker, or you pass up interest you could have earned on that money had you not bought that car and left the money invested instead. That's the honest truth. And that's what Dave, he's helping you with baby steps. And God bless Dave Ramsey for helping folks have baby steps. But Terrence, you're not wanting to just take baby steps, right? You're on for a marathon here, I assume. Correct. I'm on for a marathon. I want more than just a couple of baby steps. I want to see worlds changed. I want to see my family changed. I want to see my personal life change. So you got to think beyond just those baby steps eventually. And I had not done that. I did not think critically. That was my biggest error, was I didn't think critically about my money guru and what he was saying to me. So thinking critically is the skill that you learn in college, but I didn't apply that to my financial life at all. So anyway, opportunity cost is the truth that when you say yes to one thing, you're saying no to everything else.
Yep.
So you're financing everything you buy. If I buy a ice cream cone for my daughter this afternoon, that's $17 I won't have for her college when she's of age, right, to go to school. If I buy a car today, I won't have 200 grand in the future, depending on the rate of return and all that stuff. But it's a choice between this and everything else. So that's opportunity cost. And the trouble with paying cash for things is, you lose that opportunity cost. And in my example was all my student loan debt. When I pay cash into that hole called my debt, I was losing hundreds and hundreds of thousands of dollars in my retirement as I made that choice every month to throw a little extra toward old Sally and her cronies. So that's opportunity cost. What would you add to that, Terrence?
I wouldn't add anything. That's a really good way of explaining it. Yeah, and I always say it. It's kind of the Robert Kiyosaki thought process. You have to have a career, and your money has to have a career, right?
Yep.
And if your dollars is an employee and you hired it, which would you be hired me, and you show up every day, and I'm just sitting there on the desk with my feet on the desk doing no work, would I still have a job by the end of the week? And so that's a simple way of me telling people you have to put your money to work. The same way you get up and go to work every day, your money has to work, especially with inflation. Right. What was that? 7%, 7.5 or 6 to 8% last year. And I explain to people, if you have money doing less than 8%, you're losing. So leverage is key. And I don't want to steal your shine. So this is important. So let's talk about it. So when you had the mentor explain that process of bank on yourself, because I guarantee you 99% of our audience, the people that are listening, have never heard of that. So walk us through what that is about and when you made that big aha moment in your mind.
Sure. Yeah, that is it was a big shift for me, for sure. We had a conversation that hour, and then I had about 7 months where I had to peel back the scales from my eyes and open up my mind a little bit to really understand that there is a truth to that statement that you finance everything you buy. And the biggest, I guess, options one has for, let's say, buying a car is either you finance it, you lease it, or you pay cash for it.
Mm-hmm.
And that's basically what we're all taught. And that's honestly true for 99% of Americans. That's the options. Buy it with your own cash, or you got to finance it with a bank, or lease it, which is more like renting the car. So if you finance it, obviously you're on their dole. You're on their take. You got to give them some money every month. You got to pay them interest every month. If you stop paying the car off, they're going to come repo the car. If you finance it, you don't even have a car at the end of the deal because you got an old, beat up 5-year-old vehicle. You got to go back into debt to restart that whole cycle all the way over again. If you lease the car, you don't even have anything to sell at the end of the term. You're just always paying 100% interest basically to lease the car. If you pay cash for the car, you feel great while you're saving the money, save up the staircase. And then as you make that purchase, you withdraw the money out of your bank account and go pay cash for the car. And it feels great for about 15 seconds. I call it it's like the refined grains. It's like the sugar crash of finance when you pay cash for something, because as soon as you pay cash for it, you got that empty feeling in your bank account, right? It feels good for about 15 seconds. You got the title to the car or whatever, but now you have nothing earning interest for you, like you said. And now you've broken compound growth for the rest of your life. So your $30,000 car might actually be a $120,000 mistake over your lifetime. You multiply that by 7 to 10 cars you're probably going to buy. We're talking hundreds of thousands, if not $1 million to mistakenly buy your cars with cash. So what's the alternative? And as the CFP, I have to say, it shocked me when I figured this out. I had reviewed 450 financial vehicles, strategies, products. And of course, you can combine them together, right? Stocks and real estate and annuities and mortgages. And you can mash them all together and create infinite portfolios, right? But I'd never considered a bank on yourself strategy before. So here's what it is. Of all things, Terrence, it's a dividend paying whole life insurance policy, but it's not like Dave Ramsey and his friends are talking about. This is a dividend paying high cash value life insurance policy. This life insurance policy is not about the death benefit, although that's going to be there and that's fine. It's really about a few things. Number one, you build up an equity in the policy called cash value, just like you build up equity in real estate. Number two, it's liquid and accessible for any purpose, for any reason, at any time. You can get the money out in about 3 to 5 business days, and no one asks you any questions about it. So there's no banker who's having to lend you his umbrella, right? To get that money out. Number three, it's accessible. The tax law says you can get it out tax-free. So you could have $10 million in one of these policies and be taken out $400,000 a year or whatever, and it's all going to be income tax-free. And number four, when you access this cash, and I'll just stop with this and get your feedback. Let's say I've got $100,000 in cash value in one of these policies, and I borrow out $60,000. I borrow it out, right? So I'm banking on myself. I'm borrowing against this policy $60,000 of my $100,000. The way the contracts in these type of policies work, Terrence, is when you borrow against the policy is not diminished. It actually continues to grow and compound on the entire $100,000 as if you had never taken the loan in the first place. Now, to me, this solves the problem of opportunity cost. So let's say I've got $100,000 and I borrow out 60, and I'm still getting growth on my $100,000 as if I'd never touched a dime of the money. Meanwhile, I've got my $60,000. Now, what am I going to go do with it? Terrence, can you think of anything somebody might want to do? Maybe it starts with the letter R and ends in real estate, maybe, with that $60,000.
Yep.
And might that give you 2 places for your money to be working at the exact same time, growing and compounding in the policy at $100,000 on $100,000, right? And my 60, or call it 600, or whatever your number is now being put to work in real estate or your business or sending your kid to college or paying off your student loans, like my story. The whole thing becomes a ever increasing compounding wealth system that you can use for your entire financial life.
Wow. Guys, I hope you wrote notes and took your time to really digest that, because the first question is, do you have insurance? And if you don't, that's where we need to start, right? So why would you think people need insurance? And then we'll come back to that strategy. Why do we need insurance? Why do especially 1099 entrepreneurs, why do we need insurance?
Yeah, there's no government requirement or business requirement for you to have life insurance. They'll force you to get other kinds of insurance, like health insurance or whatever, but not life insurance. It's a personal decision on a family level. If you're going to work another 20, 25 years, that's an important stream of income for your family. If you're a business partner in your real estate, maybe there's something that they're going to want to have if you should pass away, so that your spouse doesn't show up to work on Monday to work with the business partner, right? So maybe there's a relationship where if you pass away, you pay the surviving spouse, your surviving spouse, a lump sum rather than having to give him or her equity in a business. There's a lot of reasons, but the key is being responsible and keeping your promises that you made to the people on this side of the grass, on this side of heaven's gates, so that, they don't beat you up on the other side.
No, I like it.
When they meet you again.
I like it. So can we pivot? I have another couple questions I want to run by you. Inflation. That's been a big topic, obviously, with supply chain issues and construction. And we're 5 million homes short right now in America, which is ridiculous. Let's talk inflation. If I'm a real estate entrepreneur, realtor, investor, and property manager, whatever, what would be 3 strategies or three thoughts that you would put in front of me to think about inflation if you were coaching me or advising me?
Can you say that question a slightly different way, just so I answer it well? You're wanting to know 3 strategies for beating inflation?
Yeah, I would just say if you were on my financial team, or if I was looking to hire you, and inflation is something that you have to attack, what would be the first 3 things that you would have me set up as my advisor?
Yeah. The key piece here is having a strategy and not just reaction. And so as I mentioned, there's hundreds and really infinite ways you can combine your money. together for any portfolio, and all of them are going to do different things. So the first thing I would do is ask you, Terrence, what do you want your money doing for you? If you were Pope of money for your life and for the day, and you could create a perfect financial vehicle or set of vehicles, what sort of attributes, what sort of characteristics would you want your money to have? And so we'd go through that conversation. I'd recommend your audience do the same. Just grab a pen and paper and ask yourself, what if I had the perfect financial instrument, perfect financial vehicle to beat inflation, to beat everything else, taxes, because this year it's inflation, guys, but next year it's going to be something else, taxes, market crash, withdrawal rates, interest rates, the list goes on and on. It might be a personal emergency too. It might be not a world financial crisis. It might be a personal crisis. Maybe you've lost your job or became disabled or had to care for someone else who is disabled. So you'd have to kind of create your list first. What do I want my money doing for me? So I'd start with that conversation, Terrence. First, we'd look at things like inflation for sure. We'd look at tax rate risk, because isn't inflation just another like unvoted for tax? Think about that for a minute.
Yep.
So looking at taxes, that's going to be important. Do you want to pay your taxes today on the seed or 25 years from now on the harvest? What do you think, Terrence? If you had to choose today, if the IRS gave you a choice, they call you up and say, hey, Terrence, we were just looking at your file. We're going to let you choose. And how you answer this question is going to impact the rest of your financial life. Do you want to pay taxes on today's money now or in the future when it's time to retire or whatever, 25 years from now, whatever tax rates are 25 years from now? Do you think it's going to be a lower deal today, or are you going to be in a better tax rate in the future? Are taxes going down or up? These are questions you'd want to ask and answer for yourself. It's your personal decision, but most of the people I sit down over Zoom and over the phone with folks all across the country, I have not heard anybody say, Mark, taxes in this country are definitely going to be lower 25 years from now. I don't hear that. I hear people tell me, Mark, it's likely that taxes are going to be higher. They might be way higher. And they say to me, I don't want to pay those taxes. And I'd rather pay my taxes on today's money, on the seed, and let my harvest be tax-free.
For sure.
So we're looking at things. What are the things that give you tax-free futures? Well, life insurance, I mentioned, is tax-free when you get the money out. It's like a mega Roth IRA, if you can think of it sort of like that, because there's no restrictions on how much you can put into the thing. We've got folks putting a couple $100 a month. We've got folks putting in a couple $100,000 a year and more. So it's sort of like a mega Roth IRA. Other options would include real estate. Real estate gives you an incredible way to beat inflation, as you know too well, Terrence, right? Mm-hmm. You can see your rents go up as long as the government allows us to raise rents in this country. And you've got things like, indexed annuities are actually a very interesting way to increase with inflation as well. Strangely, there's not too many places where you can get inflation-adjusted tax-free income, even except those two that I just mentioned. I mean, there's maybe a few others, but would you add anything to the list?
No, I think you hit it on the head. I mean, real estate, everybody knows it's my go-to punch every time. So, real estate, it's just got so many categories, so many opportunities, and so many, cost segregation, depreciation, expense write-offs, like all kind of stuff, man. So it really helps you hedge against inflation for sure.
Yep.
And it's something that's tangible that also appreciates, that also pays you every month. And yeah, I mean, and that somebody else is paying your debt. I call it phantom income. So
I like that. I like that a lot. And there's a reason why I keep real estate in my own portfolio. We work with roughly half of our clients are real estate investors to one degree or another. And they are everything from short-term rentals to buy and hold to fix and flip and wholesaling and syndications, all sorts of fun stuff that folks are doing. But what I love is when I can find the nitro and the glycerin, and when you can put them together, some really magical things happen. And this is where, again, I think this bank on yourself idea fits so well with real estate. I mean, where else could you house some liquid contingency capital for your real estate business, whether you're buying and holding, or you're going to do a fix and flip, or you're going to do the Burr method or whatever? if you've got a big pool of liquid, tax-free contingency cash on the balance sheet of your family or your business, and you can access that for any purpose, and you're going up against other people who are having to get regular mortgages and so forth, aren't you going to win those deals, those great deals, when the markets crash? Terrence has an old quote by Mark Twain. He says, a banker is a fellow who will lend you his umbrella when the sun is shining, but he wants it back as soon as it starts to rain. And what I love about the bank on yourself model is we're firing the real estate banker. Maybe we still use the mortgage for certain things. Sure, I get it. It's low interest when it's, while we're in this lowish rate environment. But the policy itself could be used for your down payments, for your property taxes, heck, even the whole purchase of your real estate. Had a guy right there in Texas, actually. He started out by using his policies to buy his down payments to finance that. And again, he's still getting compound growth inside the policy as if he had never touched the money. And he's got the rental property. And the renters are actually helping pay off the policy loan. He's in control of, by the way. He doesn't have to repay that loan. He's just paying it down so he can borrow that money out again for the next real estate deal. But he's now moved up the ladder, you might say, from just using his policies for down payments to now he's using it for entire cash purchases. He's buying 8 unit, 12 units, just whole cash purchases using his policies. And I'm cheering him on because, what bank was in the middle of all that? Did he have to beg somebody to get approved? Did he have to, lift the kimono, so to speak, to show all of his finances? No. 3 to 5 business days, request the money. It's in his bank account. And he comes to closing with cash. Easy peasy.
That's good. So when it comes to that strategy, just overall, when you're advising people, how do you decide how much, life insurance you should get? Do you take a percentage of net worth? Do you take a percentage of total assets? What's kind of that rule of thumb on should I go out and get 20 million? Should I get 5? Should I get 2? Should I get 500K? What's that rule of thumb? Is it net worth, total assets? Is there some wisdom there that we can pull?
Yeah, Terrence, there's a lot of great ways you could answer that question. And so I'll just try to be very specific to your question here. Yeah, you can have a full family needs analysis. And we usually do that calculation with each person. And it can be done on a number of levels, like you said, net worth, whatever. But the goal of these specific type of whole life policies is not the death benefit. In fact, like I say, it's almost the afterthought. We're trying to, in fact, squeeze down and cut down the death benefit to as small as humanly possible. We just want only enough life insurance so that we satisfy the government's definition for what is life insurance. And there's a complicated formula there we probably don't want to get into on this audience for this podcast.
Yeah.
But what we're trying to do is cut the commissions down, quite candidly, by about 70%. And we cut the death benefit down by about 50 to 70%. And if we can do those things, cut those expenses down, it's sort of like when you overpay on your mortgage, you're flooding that policy with equity or cash right from the start. And from day one, month one, you can access that money. It's pure equity in the policy. We're flooding the policy with a special rider called a paid up additions rider. And I don't want to get too technical unless you want to, Terrence, but the main point is if you engineer it for the death benefit, you're going to have a front loaded, heavy, lots of commissions, zero cash policy, which is what Dave Ramsey talks about. If you want a super modern, efficient, cash early policy that gets you money where you can start using it for any project day one, you'd want to make sure that it's a bank on yourself designed policy that's front loaded with cash and not commissions.
Love it. It's a lot of wisdom there, man. So I got this section called Coming In Hot. There's 5 questions that I'm going to ask and we time you. So it's like running a 40-yard dash.
Love it.
And it's been cool to see people's answers and see how they respond. All right, Mark, so I'm going to ask them and then you answer them in one word or one sentence and you just fire them out. You ready?
Let's do this thing.
Okay. Set, go. Here we go. Do you have a college degree or no college degree?
College degree.
Okay. What was your greatest challenge as a child?
Getting past the fear of sales and getting out there and doing businesses.
There you go. What was your first attempt at entrepreneurship?
Besides the lemonade stand, I sold mazes and like cartoon characters to my friends.
Man, I did that too. What was the worst real estate advice you've ever received?
Your house is an asset.
Wow. And who was the one person that made the biggest impact on your career?
Well, it's the professor I mentioned earlier.
41 seconds, brother.
Just close enough. I don't know. Do we get any kind of Hall of Fame or anything? No, I'm just kidding. Thanks for helping.
Yeah, man. 41 seconds. What's the record right now, Kyle? 34 seconds. 34 seconds.
Come back on.
Yeah. Yep.
I'll try it again.
Somebody was at 18 seconds by question 4, and then it was question 5 and they got stumped. He just sat there for like 45 seconds. He was at 18 seconds. So, yep, that's cool, bro. All right, before we close, man, this has been good. It's a lot of wisdom here. Just to clarify, give me that final thought on the bank on yourself. So it has to be a not commission loaded up front, but cash up front policy. Is there a formal name for it?
Yeah, the best shortest answer I can give you, it's like USDA organic food, comes with that seal of approval, right? There's plenty of folks on YouTube talking about this, and they call it a number of different things. And I've found that you can be getting into trouble with this if you work with the wrong advisor. There are 400,000 life insurance agents out there. There's hundreds of thousands of investment advisors out there. Don't work with just any of them. If there were 400,000 heart surgeons out there, you wouldn't necessarily just go to the nearest guy or gal and ask him to, put you under the knife. You want to make sure you're looking for a bank on yourself professional. And there's roughly 200 of us that have been trained specifically in this strategy. So look for anything that says bank on yourself, and you're in the right place.
Love it. Love it. So what's your moonshot, which is your goal or dream that other people think is impossible? It's kind of crazy to even fathom that it could happen. What's that moonshot for you in life?
I was just telling my staff and employees this the other day. What if 10% of America was doing this? What if 10% of America had a strategy and a financial plan to bank on themselves, where they were, firing their banker, getting rid of their credit cards, getting rid of whatever, and using their own source of financing for their children's colleges? Because don't forget that college comes, for every kiddo at some point, if that's going to be a thing in the future. Real estate strategies, tax-free retirement income. What if 10% of America was banking on themselves? How many marriages would we save? How many suicides would we avoid? How many businesses would not go out of business because they had a big pool of cash waiting for them to use as they needed? That's 10%. What would happen to the credit card industry? What would happen to the Federal Reserve? Right? This would change the world. And it would bring banking down from the mega banks down to the you and me level again, which is where it's been for thousands of years. It's only been a recent thing where banks have really taken the banking function away from us. So my moonshot is to put every client we work with behind the banker's desk. All right. So that they can control their financial outcomes before they even start on their journey.
Wow. God's going to use you, brother.
Let's both get it out there and see what we can do, man.
Yeah. So I have all my guests bring a book because I'm really encouraging my audience, the people in my organization. In order to be a leader, you have to be a reader. And so I'm always giving that, every guest to bring one recommended book, and you recommended Becoming Your Own Banker by R. Nelson Nash. We've talked about it a lot, but what about that book is the one thing that you pulled from it that people should read it?
Well, he says, change your thinking. And he says, avoid the worst virus of the human condition. Unlike some of the other viruses you might have heard about in the news lately, the worst virus one can have is the arrival syndrome. It's where you get caught with that virus, that you've already arrived, that you've somehow made it, that you're established, that you've figured it all out. Avoid that like the plague, because in his book, the arrival syndrome is the worst thing that can happen to a human. And it's almost what I had when I thought I figured it all out, that I just took Dave Ramsey's word as gospel. No, you got to always be learning, always be growing. So good on you, Terrence, and anybody listening to this podcast, because it proves you're trying to learn, you're trying to grow. So that's the one nugget I took that I want to share.
That's good. Yeah, the athlete in me never lets me feel like I arrived. That was the one beautiful thing about sports. You could be playing the greatest game in your life, And then you go out there the next series and you like trip or fall or run the wrong direction or drop a wide open touchdown or whatever. It's just it humbles you really quick. And
Sure does.
So it always forces me to get up every day knowing that the rent is due, right? I got to go earn that day with my effort, with my mentality. And that's what people always ask me, like, man, you played in the NFL, you did this, you've accomplished so much you're still in your 30s. Don't you feel like you've done enough? No. Man, I just wake up every day trying to beat myself. I'm not even racing anybody else. So that's good, bro. So your final thoughts for our audience, and then where can people find you? But thank you for being on the show and just having so much wisdom. But what's your final thoughts for our audience, and where can people find you?
Well, you're a great interviewer. You'd ask great questions, man. So if folks want to dive deeper into this strategy, we're all over the place on YouTube and everything. Our podcast is called Not Your Average Financial Podcast. And we've got 200 plus episodes on this strategy that I mentioned today and a number of others related to real estate and more. So go to notyouraverageFinancialPodcast.com. There's a big button there that says request a meeting. If you want to chat with me for 15 minutes, happy to answer any question you have.
Love it, bro. Thanks again, man. I'm probably going to personally reach out to you in a couple of weeks. I'm going to get settled at the new place, and then I'd love to talk to you about this strategy, brother.
Cool. Love to. Let's do it.
All right, man. Great job, bro.
Thank you. Thanks for having me on.
Yes, sir.